You've been told silver is a safe haven, a hedge against inflation, a store of value that protects you when the system breaks down. And right now, with every headline screaming about debt ceilings and currency debasement and the dollar losing its grip, you're probably thinking about buying some. Or maybe you already did. Maybe you've got a few tubes of Eagles or Maples stacked in your closet and you sleep a little better knowing they're there. But here's the thing nobody mentions when they're selling you on precious metals. Silver is not an investment. It's insurance you're paying for with your future. Let me show you what I mean with actual numbers, because this isn't about fear or ideology. It's about math. Let us say you take $10,000 right now and buy physical silver at $28 an ounce. You get roughly 357 ounces. You store it, you wait. And let's be generous and say silver goes up 4% annually over the next 20 years. That's actually higher than its historical average, but we'll use it. In 20 years, your $10,000 becomes $21,900. Sounds fine, right? Except inflation over that same period, averaging 3%, means your purchasing power is actually only about $12,000 in today's dollars. You made $2,000 in real terms over 20 years. That's $100 a year. That's your return for tying up $10,000. Now take that same $10,000 and put it in a boring S&P 500 index fund. Historically, it returns about 10% annually. After 20 years, that's $67,275. Even after adjusting for that same 3% inflation, you're looking at roughly $37,000 in real purchasing power. You didn't just beat silver, you crushed it by a factor of 18 times more wealth. You didn't have to store anything, insure anything, or worry about premiums over spot price when you eventually sell. But the silver crowd will tell you that's not the point. They'll say silver isn't about returns. It's about protection. It's about what happens when everything else fails. And that sounds rational until you realize what you're actually protecting against. You're protecting against a scenario where the entire financial system collapses, where banks close, where equities are worthless, where the dollar becomes toilet paper, and somehow, in that world, people will still honor the value of shiny metal. Think about that for a second. In a true systemic collapse, what's actually valuable? Food, water, energy, shelter, skills, relationships, security, not silver. Silver becomes valuable only if we get to a very specific kind of crisis. Bad enough that fiat currency dies, but stable enough that there's still an organized marketplace where people accept precious metals as payment. That's an incredibly narrow scenario. And even if it happens, your 357 ounces of silver aren't going to save you. They'll help you barter for a few months maybe. But then what? Here's the uncomfortable part. The real reason people buy silver isn't financial protection. It's psychological protection. It's a way to feel like you're doing something in the face of uncertainty. It's a tangible object you can hold when everything else feels abstract and fragile. And I get that. There's comfort in physical assets. But comfort isn't strategy. Comfort is an emotional expense you're paying with opportunity cost. Every dollar you put into silver is a dollar that's not compounding in assets that actually grow. It's not working for you. It's sitting there, doing nothing, while you convince yourself it's a smart hedge. Let's talk about what a real hedge looks like. A hedge isn't something you buy and forget about hoping it goes up. A hedge is something that moves inversely to your primary holdings, so that when one drops, the other rises, stabilizing your overall portfolio. Bonds can be a hedge against stock volatility. Real estate can be a hedge against inflation because rents and property values tend to rise with the cost of living. Even commodities like oil or agricultural futures can hedge specific risks in specific sectors. But silver? Silver doesn't hedge your portfolio. It just sits there, losing value relative to productive assets. Its price is driven by industrial demand and speculative sentiment, not by any fundamental relationship to your financial security. And the people who sell you silver know this. The premium you pay when you buy physical silver, the markup over spot price, averages about 15 to 20%. So when you buy that $10,000 worth of silver, you're immediately down $1,500 to $2,000 before the metal even moves. You have to wait for silver to appreciate 15 to 20% just to break even. And when you sell, there's another spread, another fee, another haircut. By the time you've bought and sold, you've given up 25 to 30% of your capital to transaction costs. You can't do that with index funds. You can't do that with real estate. You're paying a huge premium for the privilege of holding a non-productive asset. Now, let's compare this to real wealth building behavior. Take someone earning $70,000 a year. If they save 15%, $10,500 annually, and invest it in a diversified portfolio returning 8% after inflation, they'll have about $640,000 in 30 years. That's real, compounding, purchasing power adjusted wealth. But if they take that same savings rate and put half into silver at 4% real returns, their 30-year total drops to about $490,000. They just lost $150,000 of future wealth because they were scared That's not protection. That's self-sabotage dressed up as prudence. The other argument you'll hear is that silver protects you from inflation. But here's the thing. Inflation isn't something you protect against by hiding in metal. Inflation is something you outpace by owning productive assets. Stocks represent ownership in companies that raise prices when costs go up. Real estate generates rental income that adjusts with inflation. Even Treasury inflation-protected securities give you a guaranteed real return above inflation. These are inflation hedges that also grow your wealth. Silver just maintains value at best. It doesn't beat inflation. It barely keeps up. And often, it doesn't even do that. Look at the data. From 1980 to 2000, silver lost 80% of its inflation-adjusted value. 80%. If you bought silver in 1980 thinking it was a safe store of value, you got destroyed for 2 decades, while the stock market returned tenfold. Even in the 2000s, when silver had a strong run from 2008 to 2011, it peaked at $49 an ounce and then crashed back down to $14 within 2 years. If you bought near the top, you lost 70% of your money. That's not stability, that's speculation. And speculation is fine if you know that's what you're doing, but don't confuse it with wealth preservation. Here's the deeper issue. When you buy silver, you're making a bet that the future will be worse than the past. You're betting that growth will stop, that innovation will stall, the productive enterprise will fail, and maybe you're right. Maybe we're heading into a long, dark period of stagnation and collapse. But if that's your worldview, then why are you still working a job? Why are you still participating in the economy? Why are you planning for retirement at all? Because if you actually believed the system was going to collapse, you wouldn't be buying silver. You'd be buying land, learning to farm, stockpiling essentials, and building a completely different life. The fact that you're buying silver and then going back to your day job means you don't really believe the collapse narrative. You're just hedging your psychological anxiety. And that's expensive. Let me show you what opportunity cost really looks like over a lifetime. Let's say you're 35 years old. You have $50,000 saved. You're trying to decide whether to put $20,000 into silver and $30,000 into index funds, or just put all $50,000 into index funds. Let's assume the index fund grows at 9% nominal, 6% real. Silver grows at 4% nominal, 1% real. Over 30 years, the $50,000 in index funds becomes roughly $432,000 in real terms. The split portfolio, $20,000 in silver, $30,000 in stocks, becomes about $284,000. You just lost $148,000 of retirement security because you wanted the psychological comfort of holding metal. That's almost 3 years of living expenses for the average retiree. You traded 3 years of freedom for the feeling of safety. And let's be clear, I'm not saying you should have zero exposure to alternative assets. I'm not saying you should ignore risk. What I'm saying is that silver specifically is one of the worst ways to diversify. If you want protection, buy real assets that generate cash flow. Buy rental properties, buy dividend-paying stocks, buy tips, buy I-bonds. These are assets that protect you from inflation and also build wealth. They serve 2 purposes. Silver serves one purpose badly. The reason this matters is because your financial life is built on compounding. Every decision you make today echoes forward into your future. When you put money into an asset that doesn't grow, you're not just missing out on that year's returns. You're missing out on the returns on the returns. You're missing decades of exponential growth. That's the real cost of silver. It's not that silver goes to zero, it's that it goes nowhere, while everything else goes up. Let me give you a different mental model. Think of your capital as deployed soldiers in a war for your financial freedom. Every dollar you have is a soldier. Some soldiers are on the front lines, earning high returns but taking high risk. Some are in reserve, earning moderate returns with moderate risk. Some are resting in cash, ready to deploy when opportunities arise. But silver? Silver is a soldier you've sent to guard an empty castle in the middle of nowhere. He's not fighting, he's not training, and he's not building anything. He's just standing there, watching nothing happen. And every year you leave him, there's a year he could have been on the front lines compounding your wealth. Now, I know someone's going to say, but what about 2020? What about 2008? Silver went up during those crises. And yes, it did, for a moment. But then it came back down. And even during those spikes, it didn't outperform a balanced portfolio over the full cycle. The problem with using short-term price movements to justify long-term holdings is that you're cherry-picking data. You're looking at the best 3 months and ignoring the worst 3 years. Wealth isn't built on volatility. It's built on steady, disciplined, long-term accumulation of productive assets. Here's what actually protects you in a financial crisis: diversification, cash reserves, low debt, marketable skills, a strong network. These are the real hedges. If you lose your job tomorrow, having $10,000 in silver doesn't help you. You can't pay your mortgage with silver. You can't buy groceries with it. You'd have to sell it, pay the spread, take the loss, and then convert it back to fiat currency anyway. But if you have $10,000 in a brokerage account, You can liquidate it in 2 days and deposit cash in your checking account. It's more liquid, more flexible, more useful. And over time, it grows faster. The people who really benefit from silver are the dealers, the refiners, the storage companies, the YouTube channels and blogs that get affiliate commissions every time you buy. They've built an entire industry around selling fear and calling it prudence. And it works because fear is a powerful motivator. But fear-based decisions are almost always bad financial decisions. Investing is about allocating capital to its highest and best use. Silver is not the highest and best use of your capital unless you're a jeweler or an electronics manufacturer. Your wealth is built by owning pieces of the future, not by hiding from it. Every dollar you put into silver is a vote against growth, against progress, against your own financial potential. And maybe you're okay with that. Maybe you really do think the system is broken beyond repair. But if that's the case, then act like it. Don't hedge. Commit. Because half measures don't protect you. They just make you poor. So what should you do instead? Simple. Build a portfolio of assets that grow: stocks, bonds, real estate, index funds, boring, proven, wealth-building tools that have worked for decades. Keep 3 to 6 months of expenses in cash for emergencies. Pay down high-interest debt. Increase your income. Lower your fixed costs. Invest the gap. Let it compound. That's it. That's the strategy. It's not sexy. It's not dramatic. But it works. And 20 years from now, when your portfolio has quadrupled and your silver has barely doubled, you'll understand why boring wins. Because here's the truth they don't want you to know. Silver is a product marketed to people who are scared but don't want to admit it. It's sold as wisdom, as preparedness, as financial sophistication. But in reality, it's a low-return, high-friction, emotionally driven asset that only makes sense if you believe the world is ending but you're still planning for retirement. And that contradiction should tell you everything you need to know. The choice is yours. You can buy metal and hope the world falls apart just enough to prove you're right. Or you can buy assets and build wealth regardless of what happens. One is a bet against the future. The other is a bet on it. And over any meaningful time horizon, the future has always won.